Welcome DCUC members to the recorded segment of our Defense Matters Forum. With us today, we're honored to have the Vice Chairman of the National Credit Union Administration, the Honorable Kyle S. Hauptman. Mr. Vice Chairman, thank you again for being here today. It's always a pleasure to have you at our DCUC events. And most importantly, I really appreciate the fact that you take the time to meet with our members and to join with DCUC, especially for those that are unable to make the trip. So I appreciate you coming into the studio. We're here at the beautiful NAFQ studios, who've been gracious enough to lend us their studios and their crew, and we're very happy to be here. But it's always important to see you, particularly as we do person-to-person interviews, have you meet and talk with our members, and really just to give them a good sense of what's going on, at the NCUA, which is the essence of good government: open, transparent, and very responsive. And so, again, thank you for being here, Mr. Vice Chairman. Are there any words you'd like to say before we get started?
Sure. One, I'm glad you like having me here. I actually think if you have a career, you're pretty good at this, Charlie Rose type. You have a career doing interviews, I think, if you want to. And I agree with you on transparency. Be out and about. I've seen it where agencies can get closeted by speaking only to their colleagues, as brilliant as they are, but not into the people you're actually supposed to serve. So I think these are useful. And I'll say this, that we did this a year ago, and I talked about my 3 priorities, and they're still my 3 main priorities. As you know, you can't have too many priorities or else it's not a priority.
Right.
And number 1 is de novo. It was so difficult to start a credit union. Years-long process. A lot of people just give up. Even if you're just pursuing a state charter, NCUA is usually still the roadblock because they won't open until you get NCUA insurance. So I'm pleased to say we've had major progress on that. Number 1, revamp the whole option. 2, communicating, like where you are in the process. Are you almost there? Are you halfway? And because I think it's true financial inclusion. Like a lot of agencies, we do a lot of self-congratulation on inclusion issues. But to me, the ultimate financial inclusion is allowing a group of people, a field of membership, who obviously are not satisfied with their current financial service offerings, to create their own credit union. And if we are stopping a mosque or a church or a small town or a group of farmers, if we're making it any harder than needed, we might want to re-examine our commitment to financial inclusion. So we've got a revamped process. We're now going to have annually at our NCUA board meetings, at least once a year, the person in charge of de novo give the numbers, how are we doing, what's the pipeline, talk about the new ones that have been created in the last year or 2. We know there'll be some failures because that's just how it is, but I'm very pleased that we've made progress on that, and there are going to be credit unions, I think, due to my initiative, that I don't think would have existed otherwise.
That's great. I mean, that's the heart and soul of America is forming those common bonds and going for it.
And it's fun. As we know, the number of credit unions, just like banks, goes down every month. Not always a bad story. Sometimes it's a merger that works for all parties, but sometimes it's a merger because one of them is really struggling, and sometimes we, as the insurer, have to conserve them.
Sure.
So it's fun when you have the new ones.
Yeah.
Someone's birth announcement is more fun than a funeral, right?
Sure.
The new ones. So de novo was one. The second one was technology. I always say I don't want to see credit unions slowly go the way of Blockbuster Video because their regulator wouldn't let them compete. Specifically in the area of blockchain, which is the underlying technology to cryptocurrency, we've put out some guidance, and various credit unions are experimenting with various things. One is like title. As you know, credit unions primarily do car loans and mortgages. What they both have in common is you don't have title,
right,
or else you wouldn't be getting a loan. And that process, especially real estate title in this country, is a little creaky. But that, and there's a number of things, probably some of which we can't think of right now, the way that the internet is used in ways that we didn't think about 25 years ago. But we put out some guidance. I'm very proud of it. It's different than some of the other regulators. And I'm not here to encourage anybody to pursue any project. But the reason it was guidance and not a rule is because this stuff didn't break any rules.
Right.
If you wanted to use a blockchain-based technology to identify customers, that's a big deal, or to send money abroad, remittances, it was cheaper, faster, better, more secure. I'm pleased that the efforts we've made there, but I know we have more to do. I think that'll be a top priority till the day I leave NCUA. And the last one was what you said about transparency. Modern, for lack of a better term, customer feedback. Now I know as a regulator or insurer, they're not customers of ours, but I think we even have more of an obligation to do transparency because customers can leave. So we now have automatic feedback surveys real quick. You do it on your phone, like 5 questions. And then the last question, this is after an exam.
Right.
The last question I made sure is always, what other questions should be on this? Because things change. And we've gotten some really interesting feedback. So the idea is, it's just like if you take an Uber ride or you use one of the food ordering apps, it's immediately, how was your experience, right? And a lot of states do this already. So we were in a weird situation before I got here where, your state regulator would give you the form or online, rate us, how did we do, but we weren't.
Right.
So I'm glad we did a pilot. It's worked well. It's the same sort of thing again as Uber, Lyft, DoorDash, any of those. Both parties fill it out. If everybody does it, we're trying to embed it into the process so it's not another thing to do. And we want to remove any stigma, right? If everybody's doing it, it's not odd. But also the mere fact that you're providing this transparency, as you know, solves a lot of problems.
Sure.
When you're on hold with American Airlines or even my local government, they'll say, this call is recorded for quality assurance, right? It's not that they go to the tape. It's to remind everybody, this is recorded and we behave a little better. But I'm glad our feedback survey says, was everything you had to do put in writing? And this came from my time on the Hill. Furious constituents saying, regulator just left, told us to do this. We don't have to do it, right? They're not allowed to say that. And I said, all right, can you send me what you got? You got an email, a form, anything? No, it was just verbal, right? So again, that's why one of the questions is, was everything you have to do put in writing? Also just useful for, let's say you're a brand new CEO, you weren't around at the last exam. The last thing we want is a miscommunication, right?
Right.
And then also, this applies for federal charters, that's about 60% of the credit unions in this country. You are encouraged to record your exit interview when it's all done, your exam, right? There's a place for private conversations, we know. You have your exam, but then when they say, okay, CEO, board, you're a camel 2 and this and that, and by next year you should do this, to record that, and it's never been easier. The pandemic, actually, a silver lining of it, was it accelerated that, because Teams, Zoom, it's very easy to do. You just hit the button, everybody sees that it's recorded, and then whoever records it, when you hang up, you get the file, and then both NCUA and the credit union have it.
Nice.
As you know, with transparency, same with police with body cameras, everybody behaved better, and it's just useful information.
Yep.
Right. I doubt you and I could repeat right now the first 10 words we said to each other today. And this is in the last 20 minutes. Yeah. So to try to remember what examiners said and how they phrased it.
Sure.
This is 2023. We don't have to worry about these things anymore.
Right. Did you get a different impression?
And, hey, our examiner said this. No, I think I meant this. You could call the examiner and say, hey, what did you mean by that? We have a little internal dispute here. They might not remember. They've done 12 exams since then.
Right.
So you say, all right, we can read the transcript. And by the way, all of those services like Zoom or Teams also can make a transcript for you. Now, you may have to edit it, especially if you speak too quickly like I do. But it's very useful. And I can say this. We had a credit union appeal all the way to the board, something examiner did. I don't think anybody here behaved poorly, okay? But they only won because of the transcripts, because it was information we didn't have to argue about.
Sure.
And again, there's no smoking gun or anything. I think it was a judgment call type thing, right? Could have gone either way. We didn't uncover anything, malfeasance or anything. But they could say, okay, see on page 3 here, the examiner says this, the supervisor says this. We didn't have to argue about what happened. Just, was it the right call? Was it fair? And they won. They appealed to their supervisor, got denied, appealed to their region, went up the chain, and then the way we do it at NCUA, at least, is the last thing is the 3 board members. We're kind of like a jury. Mm-hmm. And I remember asking everybody in this who were on different sides of this, okay? The board members themselves did not agree. We obviously had our people arguing against the credit union. And I asked every single person in it, is this a better conversation, a better deliberation, because we have the recordings and the transcripts? And everybody agreed, yes, we're going to this is a more fair process. And that was, I asked my fellow 2 board members, and again, we didn't all agree. I asked the credit union CEO, I asked their outside counsel, I asked our general counsel, who's arguing against the other counsel. Does it, put aside what we decide, put aside the matter at hand. Is this a better, more fair process?
Sure.
So I'm proud of that. Anyway, so that de novo, blockchain and related technologies, and third, feedback and transparency. are my 3 priorities, and they're probably going to stay those 3. And I'm very proud to say we've had progress since the last time we spoke.
Yeah, well, I remember that conversation, and it's great to see progress. And so, I applaud you for keeping consistent on those and delivering, at least incrementally, making things better, and we look for more changes, as we go year to year, seeing that being adopted.
I have to give credit to my fellow 2 board members and for the career staff for jumping in with both feet on this and helping. Sure. And especially on the feedback part, people are like, is it weird you want to record them? I said, well, first of all, we want to take away that stigma. It's very normal now, right? Because but everyone was used to it in their normal life. This call is monitored for quality assurance, and you as an American Airlines customer are welcome to record it too if you want to. And you can't be out of a hotel for 2 hours before it says, how was your stay at the, So we all deal with these things all the time, and I was asked, as an experience, Uber or Lyft, rideshare, versus old school taxis, which one is usually cleaner, right? And they usually say, well, Uber and Lyft are normally. And it's not because of the people. We're the same passengers that we always were.
Right.
And, especially when Uber started, half of them were former cab drivers. So it's not the people. It's because we rate each other. And I want a good rating as a passenger, and they want a good rating, And so I'm a little, at the margin, you're less likely to leave your McDonald's wrapper on the floor, right?
Right.
So you get a better experience. So the career staff and everybody we deal with is now used to this world we're in. So I think that's what made it easier to get some of that stuff accomplished.
That's great. Well, moving on, now that you've been there a couple of years and in the role as the vice chairman, what are your top concerns for our industry as we head into 2023?
So at some point, the fight against inflation may yield an economic downturn. We obviously will have one at some point.
Sure.
That's just how the economy is. Now, this morning it was a phenomenal jobs report, and I think it's increased the chances we may actually get what the Fed calls a soft landing. You can beat down inflation without causing massive job loss in a recession. It's very hard to do. I'm not here to criticize the Fed. It's almost impossible to do both in this country and other places. But we're eventually going to have one, and it's probably going to happen before my term is up in 3 years. Some kind of downturn. Now, I personally don't think it's going to be a complete mayhem, world is ending downturn. It'll be a typical recession, as we had a post-dot-com crash early 2000 and the one in 1990-91. Because our last 2 official recessions were so dramatic, we had COVID, there's 21 million jobs in 1 month.
Right.
That's unprecedented by any scale. And then before that was a financial crisis, right? And both of those felt like the world was falling apart for a moment there. And so I think sometimes we forget, we can have a normal downturn. It doesn't have to feel like, people buy shotguns and gold bars and bury it in the backyard, which is how it was there for a while, the last 2 recessions. But so that's a concern. Car loans, we probably won't fight the last war. The last big economic downturn, that was broad was the Great Recession, and that centered on housing. Right. Mortgages are better now. There's more equity in the system. The underwriting is better. Even if we have a downturn and housing prices drop, call it 10% nationwide, which means in some places it'll be more.
Sure.
There's a lot of equity in the system. That was the last war, the mortgage crisis. I do want car loans. You know how expensive cars have gotten the last few years, supply chain and everything. People were selling 3-year-old trucks for more than they bought it for 3 years, and that never happens with automobiles. There's a lot of expensive cars that obviously people are underwater on, because that's how it is with cars. I do wonder if the next war, so to speak, will be a lot of car repossession. And that's a huge chunk.
Sure.
At NCUA, we insure about $2 trillion in assets. That's deposits. What those are lent against, over 85% is mortgages and car loans.
Right.
Ballpark, I haven't seen the latest numbers. It's about, call it 50-something% mortgages, 30-something% car loans in terms of dollars. Mm-hmm. So the cars are a big piece of it. I do wonder if, we don't fight the last war. It's not a housing crisis. We don't have foreclosures. But we may see, the first employee pulls in at the credit union and they wonder whose truck that is because somebody dropped their keys in the overnight box, and said, have a nice day.
Right.
I wonder about that. So that's just economic.
Yeah, I have seen negative equity trends going up, with people rolling negative equity into a new car loan.
Right. So you walk out of there with a $50,000 loan against a $30,000 car.
Yeah.
And then used car prices are finally coming down. That's nice. But that also includes the one you're driving. Right? If you're driving it, it's a used car. And so those are coming down. And then you know how it is, job loss, people may give up a car. We found out in the last crisis, again, it was about mortgages. But you still find out how many people have an extra car they don't need.
Right.
Or a landscaping business, which had 3 pickup trucks, now just needs 1. And so that's an issue I worry about if we have a downturn that creates job losses. That's the main one, and that's, we're an insurer. The whole point of insurance is for unexpected, for the bad times.
Right.
That's all insurance is like that. When things are good and normal, you don't need insurance. So as an insurer, you always have to think about when does the music stop economically. I'll also just mention a very broad one, which is what I said earlier, what I've said to you before. I don't want to see credit unions go the way of Blockbuster Video because their regulator wouldn't let them experiment and compete.
Right.
So that's a broader issue. It applies to banks as well. If we have a decentralized finance system, do they go the way of video stores and print media and travel agents and that sort of thing? But if I want to get more specific in terms of this year, if you're a credit union watching this, regardless of what sort of downturn we may or may not have, the interest rate jump last year was unprecedented. So that's mortgages and that's car loans. So you may be sitting on a lot of, say, mortgage paper for people like me who refinanced and pay under 3%.
Yep.
You're sitting on that mortgage as an asset, which has gone down in value. Meanwhile, rates are higher. So that's interest rate risk, which can beget liquidity risk. People start, skipping payments, and obviously, especially with mortgages, you have fewer prepayments.
Right.
When rates are high.
Right.
Because people don't refi, and you're less likely to want to move. So that can be a liquidity risk. So what I'm trying to do when I burrow down here on economic issues is interest rate risk, which is combined with liquidity risk, because you don't get those prepays.
Right, right. And I know that was in the, something else we're going to talk about is, in the 2023 supervisory priorities that the NCUA released a couple of weeks ago, and what you just mentioned, interest rate risk, liquidity risk, other ones, cybersecurity, credit risk, those were all included. But we also saw a lot of consumer financial protection issues included in the letter to credit unions. And I know overdraft programs is one of the things mentioned. Any insights on overdraft protection?
Yeah, they're looking at the main thing is fairness and transparency. Are people surprised by it? Is your policy known? Right, people shouldn't be surprised. What is this fee, et cetera? Right. Settlement processes, meaning, as you shouldn't. If payments are all going to go through at the same time, they shouldn't be ordered in such a way to maximize the number of individual overdraft fees. Right.
Right.
That's what I call settlement. How you disclose it, how you advertise it. When somebody says we have free checking, with a bounce check. But unlike some of my fellow regulators in DC, you have to look at when. With overdraft, that means you don't have enough cash at that moment. There's no good option.
Correct.
So you can say, we're not going to have overdraft fees, we're just going to bounce it back. So, if I late on my credit card due date, it's going to hurt my credit rating.
Yep.
It's going to be a late payment. That's hard to quantify, but it's a negative. Especially if I'm about to get a mortgage soon and I don't need any recent damage on my credit card. And your late fee for whoever you're paying, it could be a public utility, could be many times the value, right? You may be on your last leg with your landlord who says, if you're late one more time, you're out of here. So the downside to not paying that can sometimes be worse for the consumer than the overdraft fee.
Sure.
I'm not here to say I know how much anybody should charge for overdraft fees, but the only way to get rid of them entirely is to not pay the item. And sometimes that can be worse. So right. I think that's a thing to fight. But in terms of our letter, NCUA's letter this year, the settlement processes, when do the payments go through? How do you calculate the fees? Is it disclosed? What's your advertising? That sort of thing.
Would waiving overdraft fees once or twice, would that also be factored into that? I mean, if we know the member.
Because if you're somebody who maybe has one a year,
right,
and there's a lot of people who have one or two, weird cash flow issue,
sure,
or I have to have this rent check cashed, and I don't care if I overdraft because I'm literally going to be kicked out, and it's going to cost me 10 times more money, right? Those are, that's a lot of the people who have overdraft fees. So I'm not here to say what somebody's overdraft policy should be.
Right.
It should be transparent, and it should be fair.
Sure.
And this is not a bad time to mention what we talked about. When I talked about the last board meeting, you were there. Why would, for all the criticism of a late fee or an overdraft fee, okay, I think one of the reasons Americans sometimes get upset with Washington in general, and a lot of countries, people sort of are dismissive of politicians. That's just the way it is in democracies. But here's a bill I have from my local government, okay? I received this, I paid this. It's for a permit I owe my state government. It's $190, okay? I have to pay it. If I'm 1 day late, it's $440. If I'm 1 month late, it's $690. This government, my state government, routinely prosecutes people for lending at rates they think are usurious and predatory. All right.
Sure.
Now, I'm not here to say I know the right policy, but it's a little strange to me that, let's say I didn't have that $190. It's going to take me a few weeks to get the money together, and obviously I want to avoid the $500 fee charged by the government for being a month late. Well, you could say, well, why don't you borrow the $190 from a local lender, pay him back in a month with, say, $30 in interest, thereby avoiding the government's $500 fee. I can't do that. Do you know why, Tony?
Because we have a rate cap.
Because that $30 in interest on the $190 loan for a month will be considered, this is a fact, predatory.
Yep.
And usurious, and exploitive is the other word they use. Who is saying it's predatory, usurious, and exploitive?
The same.
The $30. The people charging me $500. And so anyway, I'm not here to say I know the right rate, or if I was a governor, what I would want a usury rate to be, or anything like that. It's just that there's a disconnect between how much the government says you can loan me money at, and how they treat you and I when you owe me money versus how they treat you when you owe the government money.
Right.
I guess it's just human nature, but that happens a lot. One of the reasons people are in a jam is sometimes because of government edicts, right? A lot of cities, you get a parking ticket, it doubles in 90 days.
Yep.
So you'd rather have a late fee on, or an overdraft fee. And they can tow your car. If you don't pay the registration, for example, they can put a boot on it and stop you from getting to work and earning a paycheck.
Yep.
In this case, this is for a business license for a rental property, the one I spoke about. They have every right to shut down the business. If I borrowed the money from a local lender, which listen, I don't want to borrow at high rates either. I don't want to lend at high rates, neither do you.
Sure.
But there's also the power differential, not just the money, right? If I got it from a pawn shop or something, they can't take my business, they can't take my car, right? If I don't do like a title loan.
Right.
They're going to bother me, they're going to send me notices, and it may hurt my credit. It may go to collections. But they don't have any physical power over me,
Right.
So I say this just when we have the debates about overdrafts and interest rate ceiling. It should be noted that one reason people are in a tight spot is because they have to sometimes pay government fees, fines, car registrations, utility bills, which are often government run, regulated utilities, who have much, much, much harsher penalties for not paying.
Sure.
It's just a point I like to make.
Well, I always like to say, talk about junk fees. There you go.
190 to right.
$600.
1 day late, it's $250, and it's $690 on 190 in 1 month.
Yeah, that's
People,
amazing.
you can understand people don't like to be lectured to by people charging these fees
Right.
on what they price their product at. Right? I think it's anyway. I think that a huge portion of the American public has encountered that in one way or another.
Right. That's one of the big disconnects that's out there. The supervisory priorities also mentioned fair lending, including a review of residential real estate appraisals for any bias. Any insights on that?
Yeah, that issue is hot in Washington in general and in state governments. And some of this comes to other ways of lending besides like FICO, right? Artificial intelligence, right? And my personal opinion is we should see what works. And if you use a system for lending where you're not evaluating credit risk correctly, either you're underpricing it, which we saw in the financial crisis with mortgages, or you're overpricing it, and the customer or member can get a better deal someplace else. Pricing it wrong, however you price risk, whatever rate you give somebody, whatever price you give them for a product. In a competitive marketplace, those bad policies get pushed away by good ones because people who price correctly have a much, much better advantage, right?
Sure.
And they're going to take market share, and they're going to get more employees and more customers and more revenue. So, but as far as NCUA goes, the main thing is transparency and fairness in appraisals and in rates. So I think it's fair to someone to say, we look at Fair Lending Act, et cetera. Are our appraisals, is there something going on with our appraisals? Are we appraising it too low for these folks and too high for those folks? So just fairness and transparency in appraisals, because that's obviously a big deal for mortgages. And then the same thing for rates. Is this true financial risk? And are we on the rates? And is the appraisal truly what the property is worth with no other factor? So I don't think anybody should be saying your mortgage rate should be higher or lower, or that this or that appraisal is too high or low.
Right.
But regarding a Fair Lending Act, there shouldn't be any bias based on someone's background that is a non-financial matter.
Right. Totally agree. Climate-related financial risk for credit unions. What does that look like?
So that's obviously, again, another bit of political football. The key thing is, in my view, climate and disasters affect the two main things that credit unions do, which is car loans and mortgages. A flood can destroy both of those things, can destroy home value, and floods are awful on cars. So that's your collateral. My general view is the communities know this, though, and even though they can even know that storms or hurricanes, floods, droughts, which can hurt a corn crop. Mm-hmm. We don't need to go to Puerto Rico and tell them that they have hurricanes. I don't need to go from Washington, D.C. to South Florida and say, you guys have hurricanes. You should really look out for that. People who've spent years lending against collateral that is, oceanfront or susceptible. And I don't think we need to go to North Dakota and tell them that the agriculture can be harmed and the value of your collateral, or people could lose their jobs. Oil and gas industry sometimes have booms and busts. So my general view is that, and this doesn't count for anything, this is just mine, is that interference from DC for us to go to talk to people in Florida about hurricanes has at least as much chance to do net harm to the system as it does benefit.
Sure.
The people in those communities who live there, who lend against this, have for years, been through hurricanes, way more than any bureaucrat in DC has. We don't need to tell them that. What they should know, what a credit union should have, which they already have. So part of the point I'm trying to make here is that the climate issue, to me, already is included in other work streams.
Right.
If it's up to me, there won't be a separate part of an exam that says, okay, next, climate risk. What you're talking about is risk to property because of weather-related events. And we need to do anything with data. Is the property value dropping in areas that may experience drought? Meaning the market feels it is getting more risky than it used to be. There's always risk of drought. There's always risk of flooding in, in these places. So the main thing is, does a credit union, modeling this correctly, what if there's an absolutely brutal flood? Cars are destroyed, which we lend against. People lose their jobs because you work down the street at the restaurant and it's destroyed. And your home is now worth nothing or worth less, and you're definitely not going to pay your mortgage for a while. You don't have a job, you need insurance money, et cetera. They need to think about those things. But my point is, I think they already do. And I think that's where we at NCUA should come in. It's not a separate climate risk. What we're talking about is harm to collateral that you're lending against, and harm to people's ability to pay. They have to have jobs, etc.
Is there anything, a certain percentage of your car lending portfolio has to be for energy efficient automobiles?
I don't think NCUA has any place in that.
Right.
Federal government can incentivize with tax credits. State governments do as well.
Right.
I don't think NCUA has a place in that because from a lending risk, right, what we as an insurer care about is insurance. Like every insurer, you want to get premiums but not have to write big checks, like every insurer in the world. Electric cars get just as destroyed in floods or earthquakes, et cetera,
or cold weather.
Or even more so. If you remember local to us here, what was it, 2 years ago? People were stuck on 95 in a blizzard for they spent the night in their cars.
Yeah, I think it was last year.
Yeah, a year ago, yeah. And that's a terrible stretch of highway anyway. But then it had Senator Tim Kaine from Virginia. He was stuck in there, like 27 hours of freezing cold. He said, like a lot of people, turned on his car to get heat, got warmed up, turned it off, fell asleep, woke up when he was cold, because you don't want to kill the engine.
Right.
And then wake up because you're cold, turn it on again. The electric cars died.
Yep.
And listen, I think electric cars are great. They're quiet. They're really awesome. But there shouldn't be any push to that from a regulator standpoint. We need to just focus on data and what is the risk. So we shouldn't be pushing for that. And at least in the world we're in now, Teslas run on fossil fuels because they run on the energy grid.
That's right.
All electric cars, all cars run on fossil fuels, right? There was an event in Michigan not that long ago rolling out the new electric car. I think it was from Ford, might have been GM, and they had an event with the governor, and a journalist said, "Where's the power come from?" And the governor, who probably knows this, but this was the clip, said it comes from right there, and pointed to the cord plugged into the wall. I said, okay, but there's not a magic electricity fairy, Where does that come from? And it turns out, this was a little awkward moment, that part of the country is 95% coal. So that's a coal burning vehicle. I'm not here to knock electric cars. I think they're useful, but they are fossil fuel burning. And in some cases, like depending on what the electricity grid is and what kind of car it is, it may even have higher emissions than some of the super efficient carbon combustion, right? Or for that matter, hybrids. But so no, not on that. But the world we live in, every single four-wheeled thing on the road is a fossil fuel burning thing.
That's great. I know one thing we noticed that was not in there was Bank Secrecy Act. It was kind of odd. Was there a reason why that was left out?
So obviously, as long as you and I are alive, it will probably always be an issue, right? AML compliance, Bank Secrecy Act doesn't go away. If anything, maybe it gets harder. Part of it was because, yes, it had been there since 2015.
Right.
And this is what happens when you prioritize.
Something has to fall.
So it doesn't mean it doesn't, make a difference. I'm sorry, that it's not important.
Right.
But if you have too many things on there, then you don't really have any new priorities. Also, if you have the same things there every year, that also indicates it's not really a priority, right? Sure. If something's always your top priority, well, then it's not really a priority,
Well, it indicates you're not making any progress on it either. So.
Yeah, BSA is obviously an ongoing issue, but if you've ever had to put out a bullet point list or anything that's top priorities, for our priorities letter to mean anything, it has to have a limited number of priorities.
That makes a lot of practical sense. I know you and I have talked about this before, the current expected credit loss, or CECL. Care to beat up on CECL anymore?
At every credit union conference this comes up, and I've spent 2 years now going, and if it doesn't come up, when I'm on stage talking like this, it comes up during the Q&A, right? People beat up, I feel bad for people named Cecil because he gets bad mouth so often. And again, if it was up to me, the way CECL is structured and the way it was born, CECL is sort of a subdivision of SEC, which is about investor protection. Mm-hmm. The way it's written, the way that FASB, who published it, again, they're sort of a subset of the SEC, it's for investors. And the one thing credit unions don't have is investors. No nonprofit does, even though they're now subject to CECL. So I don't know if the juice is worth the squeeze for nonprofits to comply with CECL. What I will say is we have put out a tool, which I've been told by those who need to use it, is quite useful. NCUA has a tool we've put out to help you comply with CECL. The notion of CECL is not bizarre.
Right.
Expected credit loss, right? There's always been expected credit loss since the first person made a loan thousands of years ago. But it will just, it's accounting.
Sure.
And we have a tool that should make it easier. And the very smallest credit unions, I believe, are exempt. So that's all I can say about that.
Okay, makes sense. Charitable donation accounts. I know we talked about it last year. It wasn't brought up at the time. I'm still getting a lot of interest in it. And I know we wrote a letter here with NAFQ to the NCUA a couple months ago. Is there any way that we can get that on the agenda, or at least so that we can take a deeper look at it?
I'll explain our thinking it. For one thing, I don't believe NCUA's policy is taking anyone's option away for charitable giving.
Correct.
Because charitable donation accounts, you may know better than I do, they haven't been around forever. 20 years?
Yeah, not long.
They haven't been around, right? So the introduction in the last 20 years, or maybe 16 years or so, all that did was create one more option, did not take anything away. And the way these accounts are in general, okay, and I have one at my brokerage, Fidelity. Mm-hmm. They have a charitable giving account, okay? What credit unions use with the CDAs, and the same as regular investors do with their charitable giving account, is 501c3, sort of your classic nonprofit, non-specialized. As you know, there's many, many, many other types. The defense organizations you're talking about, they are a C19.
Correct.
Right? And then, of course, there's lots and lots of kinds. They're limited to C3. It's the simplest way. If NCUA were to say, okay, 501c3, classic charity, and this long list of other nonprofits, the defense organizations, which I agree are great organizations, you know what happens next.
Well, what about me?
What about me? What about me?
Yeah.
And would have also a compelling argument. So what I want to say is, if you want to give to one of these defense organizations, consider that when you dump all your charitable giving into the CDA.
Right.
Because you still have the exact same options to give to these organizations you're talking about as you did 20 years ago. Nothing has changed. It's just the addition of one other kind of product that people didn't even have before. And as you know, picking out among, anyway, it's not just NCUA. My charitable giving account with my brokerage, it's just 501c3.
Right.
And I think they have the same situation. They don't want to start picking amongst your various children and saying which one's best, But anyway, if you do want to give to the organizations that Tony is speaking of, I'll say to you, consider that when dumping money into CDA, because you may want to keep some of that outside the CDA for other purposes.
Right. Okay. Well, I know it'll keep coming.
It will. It will.
I know. More on that. We talked a little bit about statutory caps on interest rates, right? It's kind of a separate topic. I know. We talked about certain caps on consumer protection, wise. But last month there was a very important vote at the NCUA on keeping the current cap at 18%, and it was a unanimous board vote to keep it at 18%. But I know there's been some talk amongst some credit unions to raise it to 21%. Or to implement a variable rate. And I think from what I understood, the board's considering that again in April. And so what are some of the concerns or opportunities or even some of the constraints in terms of statutory limits that you see with this proposal?
Complex issue, and the more I dug into it, the more complex it got. So we agreed to take a look at other ways of doing it, for example, an adjustable rate. Credit unions, like other financial institutions, routinely use adjustable rate products because they serve a function. Market rates go up and down.
Sure.
And Soviet-style price setting is a disaster anytime, anywhere. So the reason we voted, because in a month and change from now, if we don't vote, either in January or at the February meeting, it goes to 15. Everyone should know that just to start with,
sure.
Okay? There's only one interest rate in the law we have to follow. 15%. It's interesting because it's actually never ever been that.
Right.
my job is not to do the policy I think is best. It's to do what Congress told us to do.
Right.
We have one real policy-making branch of government, and it's the Congress. Okay, that's what James Madison decided. So, is the Federal Credit Union Act written exactly how I would write it? No. I doubt even the authors got their way all the time. But just know this, it originally was 12%. Okay, so I had to look at what Congress wanted when they wrote this, because that's what I'm supposed to follow. Not what I want, not what you want, what Congress wants. It was 12% cap set in the 60s. And we routinely had higher rates than we even do now for a lot of that period. And then in 1980, during a record spike in rates, Paul Volcker, the chairman of the Fed, absolutely, particularly unprecedented for the whole time period it happened. I think the Fed rate topped out at 20%, maybe.
Right.
I know. So during that period, 1980, where they were finally trying to crush the 1970s inflation, Congress has the rate at NCUA at 12. So during this time, 1980, when rates are spiking, they raised it to 15. Okay, this is Congress's view. This is what I have to follow. So I look back at this. They raised it from 12 to 15 during a time of much higher rates than we have now, with a clause, which is what people were talking to us about, kind of an emergency hatch, break glass in case of emergency.
Sure.
It's set at 15, period. The board has the opportunity to raise it solely if two things are true. Number one, recent rates have risen in the recent past when we're voting on this. Mm-hmm. That is definitely true of right now. Okay, the Fed even raised another quarter point since we had our January meeting.
Right.
All right, so that's two prongs, rising rates, and the second one is safety and soundness concerns of individual credit unions. That is it, okay? Not that, remember, Congress limited to those two issues. One of those was true. The second, the reason I kept it at 18, by the way, 18 is above Congress's cap.
Right.
We're already in a break glass in case of emergency. It would have dropped down to 15 if we didn't take any action in less than 2 months. Safety and soundness, and those are broad terms we use a lot. What does that mean? To me it means, and I think to our lawyers it means, and I believe looking back at Congress, okay, when they passed this in 1980, NCUA used that authority and raised it to 21%. And so within a few months, mm-hmm. meaning all of this was done with discussion with banks and credit unions and their regulator. So we know that when the prime rate was 20.5, Congress thought that the 21% was reasonable because they used this authority immediately.
Sure.
Right? And all of this was done with communication between all parties, because they didn't want to grant you this escape hatch and then raise it to 50% or something, right? This was all done to solve the problem in 1980 of super fast rises in rates, right? So if we know that a prime rate of 20.5 and NCUA's top rate of 21, we know that Congress thought that was acceptable. It is very hard to raise it to that now if our sole purpose is to follow what Congress said. And individual safety and soundness is a credit union, because of the 18% cap, already above what Congress said, is a credit union in danger of conservatorship or massively dropping down, say, their Camel rating. A Camel 1 became a Camel 3, 4.
Right.
A Camel 2 becoming a 4, right? Where they're in a desperate situation. That is what Congress told us to do. And that's to raise it above 15.
Yeah.
So if it was up to me, this would all be adjusting rates, and we wouldn't have to have our scheduled meetings, because NCUA's board meetings are not what determine market rates of interest. So they should be going up and down in a floating rate if it was up to me.
Right.
But again, we have to look at that. And we had people lobby against us, as you know, and as they have every right to in America, and saying, we got a lot of credit cards bumping up against 18. I understand that. We can't properly price risk, and we're going to lose out on income, either by turning people down, or they should be paying a higher rate because that's the risk-adjusted rate. That's true. Is that going to cause safety and soundness issue for your credit union? That's the only question. The fact that people are going to go to payday loan places, I know. And some of my friends on the left don't necessarily agree. They just think that if we have rates lower, then people will just pay lower rates. rather than going, you know.
Right.
And I have some pictures and maps of defense bases in some places where right outside the gate is the pawn shop, the payday loan, the title loan.
Well, there's a whole bunch of stuff right
It's like literally the economy for the first 2 blocks out front. And they're not there for no reason. You know, they pay their rent, which means people are using them, right? So I'm not naive enough to know that you're not going to then pay higher rate someplace else. I'm not naive enough to know that a credit union's earnings can be negatively impacted with a rate of 18 or 15. I know that, but that's not what Congress told us to do.
Right.
It would only matter if the rate cap was causing us as an insurer to be concerned about the health of an institution.
Sure.
Having a credit union that's financially healthy, producing cash flow, and the rate cap caused it to be 5% less, let's call it profit in this case, right? Net income. Causing it to be 5% less than it would otherwise, I don't think you or me or most people think that's what Congress meant when they said safety and soundness issues.
Different issues.
But I'm not naive, you know. I'm the one who complains about government rate setting and what they charge all the time.
Right.
So I know it's a hot topic. The only thing that I think we can all say is it appears, or at least the market is priced in, only another 50-something points by the Fed this year.
Right.
Market could be wrong, but you know, maybe another full 100 basis points. I don't know. I'm not trying to predict the Fed. I'm saying that to the extent this is an issue, we do not appear to be in 1980-81.
Okay.
Where we're going to be at 20%.
That makes a lot of sense. Speaking of government-imposed fees, you know, CFPB just a few days ago proposed a new regulation that caps credit card late fees at $8, right? And I know the rule was discussed by Director Chopra at President Biden's Competition Council a couple days ago, and now we're seeing that you know the new White House Chief of Staff is looking to aggressively push agencies to finalize their rulemaking, you know, in this area, just for different things we're looking at. Is the NCUA promulgating any rules with respect to late fees?
No, we are not. Now, credit unions that are subject to NCUA, to CFPB's rules will have to follow that. As a general matter, I don't comment on Congress's job.
Right.
And I don't comment on other agencies.
Gotcha.
It's the SEC or the FDA or whoever, you know. They do their job, I'll do mine. What is interesting, and you're right, there's a lot of political support for this. I believe President Biden's Twitter account retweeted the CFPB's Twitter where they announced this. But somebody on LinkedIn who's used to work at CFPB pointed out something pretty interesting to me. I was kind of impressed in a way that the cost benefit of these price caps, and I'm not here to say what the right rate would be. I've paid late fees before and I don't enjoy paying them like anybody else. Nobody enjoys.
Sure.
And I don't know if I ran my own credit card business what I would charge. But it did say in their analysis, in what the CFPB published, it seemed like they got the cost benefit down pretty well in my opinion, because it said, you know, for the majority of people who don't pay in a given year any late fee ever, this may cause costs to go up for them. Mm-hmm. And the CFPB's own data says 75% of people in a given year don't pay any late fees for a credit card, okay? So we know that it's the vast majority. The fees they pay for processing, or the interest rates if you keep a balance, CFPB said in its analysis, and I think this is fair, that those may go up, right? You know, it's like a balloon. You can push in one side of it, but it goes someplace else, especially since a lot of these are regulated institutions and they also have to keep their earnings up. So if you cut one source of income, something else has to go up, rates, other fees, et cetera. And I'll give the Bureau credit for saying yes, the vast majority of people would likely wind up paying more for this.
Right.
Under this policy.
Would it also encourage more people to not pay since it's only $8?
I think that was in there too, right? I mean, any penalty.
Sure.
You know, not paying.
You know, that's the price of a hamburger, you know.
Yeah. Or just, you know, it's not that I don't want to pay. It's how hell-bent you are on making sure it's paid on time, right? With that bill I showed you earlier, I was very focused on getting paid, on making sure I got it paid, right? And I would do whatever I could, including incurring a $50 fee from my financial institution to make sure I paid theirs, right? So yeah, it's an interesting thing. You're trying to give benefits to those who routinely pay late fees and raise costs for the rest. And maybe that's the right policy. I'm not here to comment on it. But I did think it was interesting how they broke down the cost benefit. And I was actually kind of impressed that they took these things into account, right?
Sure.
And if you drop a fee from, say, $30 to $8, any product that has a lower price is consumed more. So it's not like they're not unaware that there will be, you could expect more late fees, more people paying late.
Right.
Because the cost is lower.
Right.
Any product is like that.
Gotcha. No, that's interesting. We'll see how that goes.
Yeah, see how it goes. But again, I'm trying to not comment on any policy, but just regurgitate what's publicly out there.
I appreciate that.
Because I know that regulators are not supposed to say anything about other regulators.
Yeah, and I appreciate you, at least talking about how they price that. Well, Mr. Vice Chairman, that's the end of the topics that that I had to ask you about. Are there any rallying thoughts or words of encouragement you'd like to make to our audience?
I would just say two things. Number one, what I said, if you're a federal charter, please record your exit interview. Now, those are usually 20 minutes, an hour, I think is long. They're pretty easy to record. Even if you're all in person now, you just set up a computer on Teams and call in and hit the button. You send a copy to us. It's a benefit to everybody. I'm trying to reduce any stigma or strangeness about it, right? The world we live in, it's normal to do these things. And while we agree there's a place for private conversations, i.e. the entire exam, sometimes people ping me about their exam and how it went. And I say, were you your federal charter? Yeah. Did you record it? No. You're making it way harder on me to help you.
Right.
So please record. And in some states they allow it if the credit union asks. I think California is like that, some others. So if you can, it's easy to do. We have to normalize it. It's normal. It's the world we live in. It's never been simpler to do. And the other thing is, you can contact me directly. So Kyle Hauptman, right? You can find me on social media. I'm on LinkedIn a lot. If you ping me there, I have to use work phone, work email for everything work. So all I will ever do if you ping me on social media is please send this to khauptman@ncua.gov, okay?
Right.
I would say, the NCUA is not that massive an agency as, it's not the Pentagon. You can speak directly to me and ping me if you wish. And like any organization, like a military organization, there's the rules of engagement set here, and then there's what happens on the battlefield, and a lot of levels.
Right.
So we're not that bureaucratic as agencies go, but that's my second thing, right? Number one, record, or you can make it a lot harder for me to help you if there's an issue. And number two, you can ping me directly, because sometimes it's easier. And we've gotten real results without getting anybody in any trouble. Sometimes operational things, little things of feedback. Again, khauptman@ncua.gov. You can find me on social media, to which I will reply, email khauptman@ncua.gov. But that's what I would leave you with. And for the defense credit unions in particular, we all appreciate the excellent service you provide to our men and women in uniform.
Well, thank you, Mr. Vice Chairman. That was an excellent rundown of a lot of topics. And again, I always enjoy these conversations, the dialogue, and I know our members appreciate that as well. And I know you've always, like you mentioned, you're always willing to meet with individual CEOs or DCUC members and talk to them about things that are going on.
Or a teller at a credit union.
Yeah.
They can ping me.
Frontline workers.
The closer you are to what's happening, usually the better decisions I think we make.
Well, I think it's just indicative of the customer service you provide, for that direct dialogue, which I believe is always important for building trust and understanding, especially on matters of importance. And so, I hope all those of you watching, will catch DCUC at our future events. I want to thank NAFQ for use of their beautiful studio and the crew in back that's helping us put this together. We will post this on our website for access later. But again, come to a DCUC event. You're more than likely to find the vice chairman at our events or any of the other board members as well. And so again, thank you, Mr. Vice Chairman. And the DCUC audience, thank you for your support.